Hello and welcome to This is Property with John, Pidgeon and Rachelle Kroon. And we have a special guest on the show today. We're not going to bring him in just yet because he needs no introduction. Rach, we're going to have a chinwag today and we're going to cover a few different things that's really just, I suppose, happening out there in the markets at the moment. We're talking about $1 million median prices across the country. Where did that come from? We're talking about lending boom, which is right up your alley. We're talking about maybe what the whole world's doing in terms of inflation and unemployment and a whole range of things. We're also going to take on a little bit of feedback we've got from a previous episode. So we're looking forward to, I suppose, owning that as well, Rach.
Amazing.
All right, let's get into it. All right, Glen James, welcome.
Thank you. Did I need no introduction because you don't respect me?
Just because for the listeners of the show, they would well and truly know.
Well, they might not.
They could not.
No.
So you tell us, where have you come from? What do you do?
I host the Money podcast.
It's a 30-minute podcast too, so just...
Yeah, and I'm only here because we've had some quality control issues and the boss needs to come in and just make sure that you guys are all sorted. So we had some complaints.
We've gone rogue.
So the boss has just dropped in to make sure everything's
there you go.
Happening.
All right. Okay. Take for that what you will. So... Rach used a term, Macquarie moves the canary in the coal mine, and a lot of people listening in might be thinking, what the hell does that mean? So first of all, Rach, can you kick off with that?
Yeah, well, the big change that happened in the market on Friday was that Macquarie Bank, who's now Australia's fifth largest lender, they're also the lender that most brokers would turn to for this trust strategy.
A CBA, the first four?
Yeah.
And again, the quality control thing, you should date stamp when you're recording this.
Yes, date stamp. So we're recording this on, what day
Friday
is it?
the 5th. Oh, Wednesday
November
the 5th of November.
November the 5th. And Macquarie pulled out of trust lending on the 31st of October. So that's for all trust and companies. They've just said, if you've got a property in a trust or a company, we're not interested in lending to you. They were also probably the number one lender doing that kind of work. But it kind of changed recently, and you know about this. It changed because a lot of people were using trust strategy for this borrowing capacity thing.
Yeah,
and we've talked about this on the podcast.
We have, and we've been skeptics of this because essentially it was brought in to basically try and increase someone's servicing or keep their servicing by siloing it into a trust. So we'd make that purchase in a trust as long as the accountant said, yeah, look, the income meets the expenses. We're all good with that, right? So now we can continue borrowing on in our personal name and the servicing doesn't change, essentially is what they were trying to do, right?
100%. And I think when you're buying a property in a trust or a company for your overall strategy, it can be a great idea. But when things like all these policies, when they catch on and there's property spruikers and people jumping on and pushing people to do something for a particular reason where this niche is just for servicing.
Yeah.
And I was just looking this morning at my ads and one of them, it was a property spruiker and this was what the ad says. It says... how to stack properties without hitting debt limits.
There you go.
So, you know,
Use a trust or a company.
Yeah, so when
so
stuff
they
like
need
that,
to pull that down.
Yeah, so obviously they're getting a certain type of business. Macquarie have gone, wow, there's thousands of applications of these trusts.
Yeah.
This could be high risk. And they just went, bang, we're out. And I'm calling this, and I said it in our meeting yesterday in the office, this could be the canary in the coal mine. Yeah. And everyone looked at me and they didn't know what that meant.
Yeah. Okay, so quickly explain that, first of all, so that all our listeners are clear.
So when there was coal mining back in the olden days, when the canary was to die, they would go, well, that's when oxygen is running out. So all the coal miners knew to get out. So the canary in the coal mine is a little sneak of something before something big is going to come. So when we say the canary in the coal mine, we go, that's what I do with my old language.
If you were born before 1985, you get it. Otherwise, it needs to be explained.
Question. You said Macquarie's the fifth largest lender. Now I did hear that as well. Do the other four do trusts and companies?
Yeah, they do trust and companies, but not not as well with this niche policy, which this niche policy that everyone's going for is, I want to be able to get an accountant's letter that says that that trust looks after itself, washes its own face, and then I can just keep on borrowing endlessly. So there's other banks that do trust and company borrowing, but do they do it as with that same niche?
Fast and loose.
Well, are they fast and loose? Maybe not.
Yeah.
So you know, you guys are in the property world. I see that as more of a commercial play that if they just stopped doing it, they could have just said, we just want some more scrutiny. I actually think it's a play that Macquarie just want to go after homes and volume, and because their service turnaround is fantastic, right?
It is.
Now, it gets complex and slow real fast when you're doing that type of lending.
Yeah.
So I think it's could be a lot of that commercial decision as well.
Yeah, but we see this I've seen this a number of times, and it always goes on when people jump on a bandwagon of a niche policy, the bank will go and pull it back, but they pull it back further. So I'm going to go back to the olden days of 2007 and it was Westpac that did low doc lending, and you didn't need an ABN.
No.
It was so loose, this low doc lending, but when they got a high risk book for that, they didn't just pull out of low doc, they pulled out of all self-employed.
Yeah. It's the same as the super fund lending. Everyone was onto it.
That was the next
while
one,
they were onto
yeah.
it, and then it just got too hard, too annoying.
Coincidentally, the Westpac thing was also an accountant's letter, wasn't it? So
they didn't even need an accountant's letter.
It was even,
It was self-certification back in the wild west.
Yeah, and I think it transgressed to that. But so I think and we don't want to say we told you so, but we sort of did. It's like, well, okay, if you're going down that path, just understand that things can change and don't take your eye off what you're actually doing it for. And I think it's like, okay, if we want to buy multiple properties, that's great. But if we buy well, we can continue to buy properties generally anyway. We just got to be wary of what the yield's doing and the cash flow, because essentially our servicing is compromised.
And it's probably important to say that they're not going to recall loans that are already on commercial.
No.
Or like in companies or trusts. They're
Absolutely
just not writing new loans.
Nothing's been grandfathered. They've just come down hard and fast and said no more company or trust lending because they saw that as a risk. And I guess the big thing is to know that these things change. So we have a lot of trust and company borrowers, and a lot of people are doing it really well and for the right reasons. I always just say to not pick your strategy around a niche policy, and this is a perfect example of why not to do that.
And the problem is for those who are out there that have done that is you're doing it with the view of that second property, not this property.
That's right.
So now this second property might not be possible anyway because of what we've done in the first place, because now this policy's taken.
That's right.
Unless there's other lenders out there that'll still do it.
There's still a lender that's doing it with the letter. I cannot imagine once they get all of that flow through, it's not going to be too long before they go, oh, we're the only one.
Yeah.
That's our risk and we're out,
which
happens in a lot.
Yeah, and this is probably for the listeners, me not being the property guy or gal, are we saying, because in the ordinary course of business, usually a business owner would have a company or trust structure, an entity structure, right? And so I've got a family trust, I can buy units in another trust and all that set up. So if I wanted to buy a property in my trust tomorrow, set up, good to go. And because I just brought up an article here about, they call it the loophole lending, they're stopping. So mum and dad, they could be employees, school teachers, nurses, or whatever. They were going to these spruikers, you're saying, and they go, set up a company, not because you need it to trade or you brought estate planning or entity structures, literally just because we can get you more debt.
It's almost like a bucket.
How to just keep borrowing without worrying about serviceability caps. What could possibly go wrong? And you see when people catch on to a niche policy like that, we use that policy a lot, by the way, and we used it and it was great for our clients, but probably not for people that were debt stacking, trying to avoid serviceability.
Well, and the other risk for these people is trying to find neutrally geared property right now is harder. So have they actually got neutrally geared property right now according to the law of what the accountants said they have? I don't know. because a good chance they wouldn't have. So in a trust structure, that makes it very, I suppose, compromised in terms of their day-to-day cash runnings.
Yeah, that's right. And you'll still be able to borrow in a company or a trust. It just may have a little bit more rules around it, and it'll probably go to the major banks that are a little bit more, cautious with that kind of lending.
On the 1st of July 26, the stronger counter-terrorism AML, anti-money laundering regulations are coming in. So it will just be more work to actually, process all this.
Yeah,
so this is the crazy thing, right? So I've got the discretionary trust and my trading company. So the trading company is owned by my discretionary trust. And you'll see this more and more every couple of years, and I've just had it with ANZ. They've emailed me and said, you need to provide new ID for all beneficial holders of your trust and company. Now, I didn't have to do that 10 years ago. I was in London at the time and I forgot about it. They froze my trust bank account until I provided and the reason why, this goes back to broader estate planning. My family trust, the actual principal controls of that are my mum, my dad, and my sister. So I don't control my family trust. My parents and my sister does, and that was for asset protection purposes. So what I had to do was get mum, dad, and Lauren AML'd with ANZ. Lauren wasn't an ANZ customer. She had to go into the branch.
Yeah.
So I did that for the Simo podcast business, like far out. And then 10 minutes later, like 2 months later, I'm in Europe. They send the email about the trust. Do the same thing. I'm like, well, if it's good enough for that entity that's got the same, both banks with, like, it was just a nightmare. And it's to the point now where I think I'm going to have to, just for the ease of paperwork, just remove them as the principals, and I'll just be the principal because I carry less risk now. But all that to say, this landscape of counter-terrorism and money laundering is a factor.
Yeah.
Because you remember CBA got smacked for their ATM money laundering stuff. So
no, it's just something to be aware of. But again, when we're making these key decisions, because we can't go and buy a property one day and then change the entity to the next without impacting our bottom line. It's going to cost a lot of money to change the entity if you wanted to do that. So,
but these property spruikers, the winner is the property spruiker because they're getting a clip on the commission of probably the brand new property.
100%.
The borrower is resetting. You're going, if it was the first or the second property, your land tax starts at zero. Like it's just anyway.
Yeah, I think it was a lot of companies that were preaching multiple property portfolio strategies too. So that's obviously, that's any case. Interesting stuff. Now, Rach, before we go to a break, talk to us about this lending through and at 90% no-LMI that's starting to come our way. Not just like when we look at lenders' mortgage insurance, a lot of, say, medical professionals, lawyers, even athletes back in the day, actors. So there were a lot of people that qualified for no-LMI.
That's right.
But now we've got a bank that's come out and said, right, we'll give everyone no-LMI at 90%. Talk to us about that.
Yeah, so it is for purchases and it's for owner-occupied or investment purposes, but there is a bank and that bank is UBank. So they're a good bank. They've got good rates. They've come out and said we're going to actually waive all of the requirements for industry and we'll just do 90% no mortgage insurance for everyone. Now, they are a little bit more of a conservative bank, so servicing might not be as strong as it might be with some of the majors, but a lot of first home buyers, again, it's servicing something holding them back. It's deposit. And it's just a sign of the times when things come into the market, like at the moment, it's just there's first home buyers are coming in thick and fast. And not everyone's going to be qualifying or want that government 5% guarantee. And there's a lot of industries that don't get the 90% no-LMI. So a bank will come out and go, well, we want that market share. Yeah. That's good business. It's low risk. They think the market's going to go up. So they're going, we'll just waive mortgage insurance for all of these people.
Yeah.
And
there
that's
you go.
great. And you can do that for investment. So I think that's going to be a huge win for people that are trying to get funding at the moment.
So for investment, it needs to be P&I, is that correct?
It does at the 90% for now, noting that policy has just come out. But when we see it come out from one bank, we tend to see another bank
Bit of a flow on.
follow. So that might not always be the case.
Watch this space, yeah. So it's good for someone that has high servicing, can borrow good amounts of money, but has no deposit or a low deposit. So you may have a small amount of equity in your property, you want to build a portfolio, and you can get in at 90%, but you wouldn't be able to get in at 80% unless you could get in at 90, but you'd be copping a large portion of LMI.
That's right. So that mortgage insurance, people don't want to pay it now. So it's about finding out the ways to avoid it if you can.
Which the LMI amounts are crazy right now. I feel that they just make their own rules.
Well, it's a percentage of the loan amount. So mortgage insurance gets calculated as a percentage of the loan amount, and the percentage goes up the higher both the loan size and the LVR, or the loan to volume ratio. So, the LVR at a 95% loan for, $1 million might be $50,000.
Oh, so the LMI premium's weighted on the actual risk, not just a blanket.
That is right.
$600,000 mortgage. That $600,000 mortgage could be a low LMI or a high LMI.
Yeah, absolutely,
Yeah,
because
okay.
it goes on a couple. So there's a spreadsheet that has the scale. So if it's it's an 82 to 85 is a different rate to 85 to 87. So sometimes you play around and go,
risk.
let's just put $500 more in and we
Yeah,
can reduce our
saves an
premium.
LMI. But I feel
let's not
banks
pay
in
it.
the past have also said, well, we'll bring that LMI amount back because you've been a customer for 25 years sort of thing.
Yeah, and some of the banks and ING used to do this really well. Go, if you're a low risk profile, we'll just halve your LMI or give you a reduced LMI.
Just like that.
I mean, people just don't need to compare rates. They also need to compare LMI if you have to pay it. But I think today it's hopefully you don't have to pay it.
Yeah. Interesting times. All right, we're going to take a break and then we'll come back and cop some controversy on the cheek.
This is Property is brought to you by Sphere Home Loans. Sphere Home Loans is a mortgage broker that helps our listeners all around Australia. So, if you want to get into your first home sooner, looking at upgrading, an additional property, or want your current mortgage reviewed, just search Sphere Home Loans or click the link in the show notes, and their dedicated brokers will be able to help you wherever you are. If you are, however, after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. That's moneypodcast.com.au and click Get Help.
All right, Rachel, we had a conversation with a guy who talked about the boom-bust cycles a few weeks ago. It landed and there was a little bit of, feedback.
There was some feedback.
Yes.
Before I give that feedback, though, I want you to tell us what were we trying to achieve with that episode?
Yes, if you wanted to check it out, we'll put the episodes in the show notes if you want. But we spoke about, we've got a guy on with I suppose there's a lot of skepticism out there around this boom-bust cycle that's been spoken about, and there's a number of books out there that go into great detail as opposed to a 30-minute podcast. But and there's a couple of them, I suppose. Secret Life of Real Estate and Banking by Philip Anderson, and this guy works for Philip. And there's another one, Secret Wealth Advantage by Akhil Patel. So I encourage, if you're really interested in this stuff, or even if you're not, I think you need to read those two, because it gives you a really good insight into historical land values through multiple countries, right, including Australia. And there's the skeptics say, well, that was America or that was the UK, so it doesn't apply in Australia, and yeah, whatever. Like I'm just as much as a skeptic on things as the next person. But I think what we wanted to achieve, and we love the feedback, by the way, so keep bringing it, because we want to know
absolutely
what you're all hearing out there and thinking. But we wanted to get the message across that not everything's going to last forever. Not all booms are going to continue to boom, and there will be some adjustments and there'll be some retraction of different markets. And depending on what the stability of that market is as to how much of a retraction that will be, and not all markets are equal.
Yeah, and there are cycles, and Australia's cycles might not be as elastic as the US, but we still travel in cycles. And so I guess it's important for everyone to understand how cycles go. But let me read to you the feedback that we got.
Yeah, and before you go to that feedback, like we're looking at markets, and I was speaking to our team yesterday. There is a market in the country right now, it's gone up 90% in 5 years, right? So a lot of people would not realise that that's been the case. They might be sold the sizzle to say, look, we need to go and buy in this area because it's booming. And it is. And we can't see it slowing down. But history shows us, and we've only got history to go by, don't we?
Yeah.
We don't know what's happening in the future.
Right.
But I'm not going into an area that's already had 90% growth because the affordability issues for the locals are real. And if double down on that, if we buy the wrong product in that area, we're going to be left without a paddle in the middle of the sea. I can guarantee that.
That's happened to me before.
Well,
broken boat.
yeah, and I think we've got to be really careful in these times where everyone's saying boom, boom, boom. Lending's at its greatest. The banks are handing out money left, right and centre, and all these markets are booming. We can get on the gravy train and say, yeah, let's make millions, right? So that episode was put there to just say to people,
there's cycles.
And be careful.
Let me give you the feedback.
And where did the feedback come in?
This is from Spotify. So this is on our...
Oh, okay. Cool. So, yeah, if you listen on Spotify and you want to make comments, do it.
And and I get some people reach out to me on Instagram as well and get a bit of feedback on here, but this is just straight from Spotify. It says, I can't help but worry that this episode introduced listeners to a conspiracy theorist. Nothing he said was backed up by data or references. It was all personal opinion and fear mongering. This feels far removed from the thoughtful investment advice I usually expect from this channel.
Perfect. And
what's that guy's or girl's name?
I didn't get his name because I cut it off on the photo, but a lot of people jumped on and liked that comment.
Yeah, which is great because we don't want to be one of these channels, if we want to call ourselves a channel, that just says everything's going to be rosy.
100%.
So we need to be a realist and we need to play an even game.
Did he say someone is holding supply off the market deliberately? Is this a conspiracy? That was Dane.
Well, just to that absolutely happens. And it happens that developers hold stock off the market and bring it in at a time that's going to benefit them.
Okay, for those listening, it was episode 739, the Boom Bust Property Cycle. Darren Wilson from Property Share Market Economic Foil.
And Matt says, Darren's door-to-door snake oil sales business has obviously failed, so it seems he's moved on to property. This has to be the property version of pseudoscience.
There you go.
Yeah, I'm not all about pseudoscience. You know, it hasn't happened with your show, but there was one of our other shows, I won't say what the show was, the host had a guest on, and I said to the host, that person is never coming anywhere near a microphone that I own or have got to do with, and I deleted the episode.
Right.
Oh, wow.
There you go.
So I'll probably delete that episode.
Yeah.
But I probably won't because I don't heaps care because it's done and dusted.
But we really appreciate the feedback, and I think it was important to talk about what the intent was, which was to talk about cycles. And I think that's still a really valid point that everyone needs to know.
Yeah. And you and I chat almost daily, right? And we talk about the winner's curse.
Yes.
Right. The winner's curse is real.
It is.
And I've done it myself, right? I've gone into an area, it's grown in value overnight, Glenn, and guess what I've done? I've gone doubled down back into that same area.
But that's the whole behavioural thing. Like I go and buy a crypto coin called freaking Cum Rocket or Peanut or something like that, and it goes to the moon. There's actually a
This
crypto
is
coin.
now an R-rated show, by the way.
There's actually a crypto a coin called Cum Rocket. You could buy cummies. They call them
my
cummies.
God.
And
My God.
And
where are we going
I
with
don't
this?
care.
Quality control.
Yes. Wait
And it could
to see
do
Spotify
100%.
blow up on
and
this.
you could think that you have done something good,
Yeah.
but it was luck. So what do? You go and buy more cummies. And next week you get flushed.
Oh, my God.
Like a
Can't believe I'm
freaking
hearing this.
dongy
But,
down the toilet.
Yeah, so
Hey,
the winner's curse is a mixture of FOMO. But it's also a mixture of, well, if the bank are lending me the money, I might as well spend it. So I'm going to spend it somewhere, and I'm going to spend it in areas that there's momentum and growth, and people are telling me to go and do that. So what happens? I buy at the peak of that cycle, and as a result of buying at the peak of the cycle, it starts to retract when lending slows down. It starts to retract when vacancies rise. It starts to retract when unemployment increases. Coincidentally, that's happening now, right? So I'm not here to say stop investing, right? We're here to say don't just go in with your eyes closed, right? And if you're serious about investing, I would highly encourage you get your hands on those two books just for your own knowledge.
but the guy who was on the show wasn't the author of those books.
No, he worked for the author.
Right.
The first author, Phil Anderson.
So Jamie said, yes, it's genuinely embarrassing to have recommended the podcast when freaks like this slip through the cracks. So should we delete the episode?
No.
Is it that bad?
No.
Did you listen to it, Rach?
I was on it.
Oh,
I hope she did.
all right.
I tuned in and out.
Your reputation, not mine, I guess.
Yeah. All right. So next on the agenda.
We're talking about naturopathy.
While you gather your thoughts, just while we're still talking about cycles,
Yes.
I think it's a lot of our listeners, because we've had such a long positive cycle, a lot of our listeners have not seen a full cycle yet, which is, and a lot of people jump on when they've only seen, 5 or 6 years of consistent growth, and they can think that's going to continue, and they buy with these strategies that aren't long term. They buy thinking, I can buy this now, it's going to go up, and then I'm going to sell it in a year's time and make all this money. And I think it's really important for people to look at that cycles of those books to go, and the history of the market to go, what if that doesn't happen? Is this still part of my plan?
Yeah, and for those who didn't listen to the ep and can't be bothered going back, it talks about the 18.6 year cycle, right? And so, yeah, you're right. Like I've been investing 25 years, nearly 26, right? So there's always been retractions in different markets, and there's always been downturns to some extent. If you buy good, solid real estate, you mitigate the downside of those downturns.
Yeah,
right?
and if you're buying long term.
And you don't need to sell. That's the big one, is people go in over their heads and they don't appreciate the cash flow and didn't forecast their own cash flow in their life to say, well, actually now I need to sell. But hang on, I'm selling now when everyone else wants to sell as well because the vacancies have increased or something amiss.
That's right. And something our guest did say that I completely agree with, and if we're going to delete the episode, I really want to put this point here, which is the quickest way to get in trouble in a downturn or a retracting market is to not have sufficient cash buffers or to be too heavily in debt.
Yeah.
So all of these debt stacking, I'm going to try to increase. Notoriously in cycles, they do get in trouble when things do turn because you're trying to sell properties at times where you don't want to sell.
Well, and that's my whole dance. Like at the moment, I think I was telling, well, John knows because I was about to pay him money to find me a property in Newcastle. I don't know. Was I telling you the other day? I'm like, at the moment, can't be bothered. It's just all too hectic out there. I'll wait and come back next year because it's just so hectic. And so there's that happening. And then I always think, like, I think one of the reasons I don't love property investing in Australia is the amount of inherent risk that people have to carry and the debt levels. Like, you need 800 grand at least to knock on the door anywhere near a capital city.
Yeah.
Wages haven't increased like the price of homes. So that's my tension where it's like, yeah, I want to buy property, but on the other side, I don't want to carry the debt.
Yeah, and to your point, the great Aussie dream is squashed for a lot of people right now because you go and buy what is, and we spoke about at the top of the show, median values around the country, $1 million. You go and buy $1 million property, which gets you an okay property in an okay region now, and you're carrying $800K of debt.
Yeah, that.
And you are solely responsible for that. You've got no tenant, but hang on a minute, lucky I bought 3 bedrooms. I can actually rent the other 2 rooms out to actually pay for my $800K mortgage. That's the problem that we've got in Australia right now.
And I honestly think, I think we told you, Rachel and I are writing a book.
Yes.
The quick start guide to your first property.
How was that going?
Slow. I think it's due in, 3 weeks? I haven't really started yet. I'll get to it. But there's that tension where if first home buyers call me and say, what do we do? I'm like, particularly the friends around this area in Sydney are like, pretty much buy an investment property elsewhere. Yeah. If you want a property, like why are we carrying all this non-deductible debt that you can't get in, you can't service? I don't know. I just think the whole thing's cooked. But I don't want to be a killjoy on your property show.
No, well, the big thing, sorry, Rach,
Yeah,
the big thing I'm looking at the moment for people is household income. And the average household income in a certain area, how does that relate to the property prices right now for them?
Yeah.
It's not about me going into that area with my household income. It's about the locals saying what's their household income versus the median price. Because if the locals can't buy and the locals can't upgrade, what's happening to that area? That's the question mark.
That's right. And not buying for the sake of buying, but still doing full research when you get caught up in this FOMO areas.
Yeah, there you go. That's it.
But I would buy, if I was buying my first property or my second property, I'd buy when it's right for me to buy. I wouldn't look at cycles at all.
Glen's thinking.
Well, he's a multiple investor. It's different.
Although you're going to say
See,
multi-millionaire.
I would say a lot of clients of mine right now that are multiple investors, what they're doing is they're saying, oh, it's a bit hot right now. They're going, I'm going to get my valuations, get my equity up. I'm going to make sure all my loans are interest only for 5 years because they've seen cycles where debt is hard to get. So let's make sure I've got cash buffers there and deposits ready for if there is some great buys down the track.
Like there's another layer there as well. Like I've just spent flipping $100,000 upstairs, so I've been busy to build the business, and I still think the business is the best investment. But what do I know?
To your friends or colleagues or whoever that are doing that, my message, if they're listening right now, is that's also fraught with danger.
It is.
Because if the market goes, yes, they're right, the market is red hot, or markets. The markets go up another 10% and then they start to retract or level out. Or let's say level out, right? Good markets level out. They don't necessarily retract too much. They now say, right, perfect time. The market's no longer hot. Okay, I go in. I'm paying 10% more than if I bought in a hot market anyway. Aren't I? Because the market's already gone up 10% in that time that they stayed out of the market being hot.
Yeah, and I wouldn't encourage trying to time the market, but I think a lot of people are going, oh, let's just hold our horses for a little minute. That's people with multiple properties.
Yes.
Yeah, and I agree. I'm not really timing the market. Well, I guess it's funny. Rach and I got into a bit of a debate the other day about rentvesting and the semantics of the words, which we can go there again if you want. But it is so hectic and busy out there. I just don't care for it. I'm just like, oh, wait, it's not an urgent purchase.
Yeah.
Where the best time to buy is when you've got the money, you've got the right headspace, you've got the right strategy nailed, and you're locked in, baby.
Yeah, absolutely.
That's the best time to buy.
I had the privilege of going and chatting to some year 11s at Ballarat Grammar last week in Victoria, and we were talking about the concept of free vesting, right?
Yes.
And they were like, what the hell is free vesting?
Sounds privileged, you jerk.
Yeah, so stay at home as long as you can, save some money, buy an investment property, and live on the oily rag.
Yeah.
So there you go. I threw that in because rent vesting, free
Love
vesting.
free vesting.
Yeah.
Okay. Do we have time? What's your definition of rent vesting, John?
We have a fundamental disagreement on the term.
But I think it's the semantics of it.
good.
I think it sounds like it's semantics. It's pretty straightforward, right?
No,
You
no.
rent where you want to live
Yeah.
and you invest where you want to invest.
Yeah. So you're just buying investment properties and renting.
Correct.
Yeah.
Yeah. But I would go one step further and say if I'm 21,
Yeah.
I'm free vesting,
Yeah. If you can, sure.
not 41. You've got to get out of home at some stage and live your
So
life.
my fundamental thing is, if you want to go there,
Yeah.
and I'll use me as an example because it's some tangible figures.
Yeah.
Because I would say I'm a rent vester, or I would say I just rent and buy own property. Like,
Well,
is
you
that-
are. You're
So
a
rent
investor.
vesting?
Yes. However,
What else could you be?
well, I could not be technically rent vesting in terms of my scenario. Can you pass me your pen, please? Because I just need, I think with my hands. So the scenario is if I could buy a place in Newcastle,
Yes.
all right, and pay $700 a week mortgage,
Yes.
right? I would
On your interest or on your P&I?
P&I.
Okay.
Okay, whatever the amount is. So if I could,
It doesn't matter.
okay, we'll make it 1,000 just for round numbers.
Must.
Yep. If I could buy a place in Newcastle and my mortgage repayment was $1,000 a week, P&I,
Yes.
whatever, right? Or I could rent in Newcastle, same location, for $700 a week, right? In my mind, the rent vesting strategy is, well, it's cheaper to rent where I want to live, so I'll pay the $700 a week rent, take that $300 extra, and then put that into growth assets like property or
Yep.
cash flow property.
Yep.
The thing where I think it delineates is if I buy an investment property and then rent, if I spend more than that $700 and pay the $1,000, I'm paying premium rent, so I lose the strategy because I'm just eating the leftover, so the whole difference was rent where you want to live, make sure it's cheaper than otherwise what you wanted to buy in the area, and put your excess money into investments. So I believe rent vesting should be camping. We're not, because like I was renting at Merriweather Heights, it was $1,000 a week. It was like, this is ridiculous.
Yeah. Okay.
And then I'm now renting for $725 a week.
Yeah.
That's a better rent vesting strategy because I'm actually not, I'm paying the minimum I can on rent
Yeah.
and investing the difference between what the mortgage would be if I could buy in that area.
Yeah.
And-
I agree, but I don't.
And this is the semantics
Yeah.
and
Yeah.
a big circular.
And so I would say if you weren't investing that money elsewhere, you're still rent vesting. You're not just doing.
You're just not
as
optimizing it.
effectively as
Yeah.
that. Where when I rent vested, I didn't have any extra money. Like I didn't
Yeah.
have any money. I just bought. I was living on an oily rag. I'm still rent vesting. I'm just not as sophisticated as you while I was doing it.
The whole term's cooked because you've got to live somewhere
You
and
do.
you either own or you rent. So if you want to rent vest, it's an intentional strategy
Yeah.
that I can't afford to buy where I want to live, so I'm going to rent cheap. And I say this all the time. You know if you're spending more rent in your situation for the luxuries.
Yeah.
So I know if I spend $1,200 a week down here at Honeysuckle, I'm wasting a lot of money and paying for the new kitchen or the third bedroom or whatever, where I can get the exact same for under $800. So I think we've got to be very strategic and sure, I like getting caught in the weeds and the semantics of it.
Yeah.
But you just can't be renting, and I'll buy a property. No, be very strategic. Rent, camp, pay as little as possible, and build wealth elsewhere.
Okay. So
you can judge.
interests of time, right?
F time.
Maybe it's another full episode on its own. And the first part of that is the rent vesting definition doesn't change, right? It is what it is. You rent where you want to live and you
Pick a
invest
side,
somewhere
John.
else around the country, right?
No, but it's got to be strategic
No,
because
no. Listen,
Yeah.
right?
Sorry,
You're
Daddy.
a guest on this show.
He's the judge. We need to listen now. We've
Right.
both put our cases out.
So yes.
But I'm the only one who has the power to edit what you're about to say out.
So you say, well, okay, yeah, the rent's got to be cheaper than if I had a mortgage here. I get all that.
Yeah.
And in your early 20s, that might be a big deal. But I know a lot of business owners, well, not even business owners, a lot of people that appreciate their lifestyle don't want to have massive bad debt in their life and just have their whole life as a massive tax deduction because they've got all investment properties, no large debt on their owner occ, and just choose to pay even premium rent because they know they want to live where they want to live and not live in a dog box.
But that's so you've actually touched on a part of the curve that Rach touched on. That is more of a sophisticated, I'm established play.
And that's what I said.
yeah,
Your early 20s might be
Camping.
You're thinking of the numbers, and yes, we get that. But early 20s, and I'm meeting more and more of these unbelievable people. And I think they are unbelievable because they're shaking the norm. What they're saying is, I don't want this large $800,000 mortgage on my own home that I'm solely responsible for.
Yeah.
I actually want some freedom and some choices. I spoke to a guy yesterday. He wants 2 to 3 holidays a year, right? He can't do that if he's got $1 million 1.2 in Sydney. So he's going to continue to rent vest, grow his portfolio, be lean with his running costs in his life and have holidays and not work for the man for 50 years.
But you've also touched on the mindset thing. So for me, I own multiple properties.
Yeah.
I've just got no desire to stomach having such large non-deductible debt in my life.
Yes.
Like, what the hell? What a waste of money. In my
correct.
view.
So that's what I'm saying. It's the rent vesting is not just about the strategy of camping.
No, but it's a spectrum that when you're starting rent vesting, it's probably the fundamentals that I talked about.
Yeah.
Where I would say I just rent where I live.
Yeah.
I just rent where I want to live at the moment. I wouldn't say I'm a rent vester.
Yeah.
Because sure, I've got all the properties. I could spend $1,200 a week on an apartment. My life wouldn't materially change that much.
Yeah.
But I still know that that's a luxury.
But you are a rent vester by definition. And
Did I rent vest in my
I'm with Rachel. Yeah.
Yeah. But do you know where the term came from? The rent vesting term?
No.
It was an LJ Hooker marketing slogan.
It's pretty good.
It is a really good slogan.
Yeah.
But I will say, on that mindset piece, a lot of people who don't own property who listen to this show, they want to buy the house to live in, and it's really hard to get to because I just need to get, and I hate the word on the ladder because I don't like all the property world that you people are in.
It's an elevator.
It is. But they want to get on the ladder and we need to buy a home to live in. But what tends to happen as you start to build wealth and you buy an investment property, once you have that property and you own it and you're now a landlord, the renting part doesn't seem as futile because you are physically building wealth elsewhere and you are making progress.
Yeah, and that's why I asked you before when you were doing those numbers is it principal and interest or is it interest that you're calculating? Because interest to the bank or rent to the landlord is essentially the same. It's both money that's not coming back.
Well, you've got to live, you've got to pay housing.
Yeah.
And the better that you want it, the more you want to do financially, spend as least as you can on a house that you live in, be it non-deductible debt or rent, buy as little car as possible, marry the right person, and keep out of consumer debt, and you'll probably have a good shot.
It'll be real good
Of making a life.
You'll be better than most.
And I think that's the best and most effective way to rent vest. I think that strategy is very solid. But I just think those people that have no spare money are still rent vesting in their little way.
And maybe for our book, we can do a bit of a rent vesting spectrum where if you are just starting out, because the hardest thing is getting that first property.
You should write that chapter.
I will. It's on the list.
You should write one on not to have kids because that saves you about $3 million.
100%.
No, I don't know if
So just for reference for your numbers, I think it's interest versus rent. It's not P&I versus rent.
Yeah.
Right.
Because the principal's actually paying down.
That's right. Whatever that is.
Yeah.
I'm just saying, traditionally, if you want to rent, you would probably want to have it cheaper than the interest-only payment.
Yes, slightly disagree, but
No, because with this rent vesting thing, you are now stepping into a potential tax strategy. And for me, with all, like, I've got a handful of debt and, you know, you got the depreciation and all that. There is a lot of deductible debt and it's borderline tax strategy. I'm self-employed. I've got some costs at home. Like, well, I don't this financial year because I moved out, but when I had the studio in the spare room, that rent was deductible as a business owner.
Yes.
Because you wouldn't want to really do that if you own the place because it just messes with your cost
Correct.
base.
So that's why your rents per week can be higher than what you're putting over here.
Yeah, I just think you want to spend as little as possible on rent.
I'm looking forward to the rent vesting spectrum.
Friggin' hell. I'm going to put this episode into AI and get us to do a summary so I can have some skeleton to... I
know.
But anyway, I think it's the semantics thing, but we can all go back and land on the fundamentals. To build wealth, you want to spend as little money on stuff that goes down in value. And you know, if for your situation, if you are spending on luxuries, and guess what? Luxuries in your life could be an extra $300 a week rent.
If you choose.
If you want.
Or a car or something. Yeah,
exactly.
That's right. You do you.
All right, see ya.
All right. You've been real.
Hey, everyone.
I don't know where the hell that all came from.
On the Spotify comments, tell me how much you hate me being on the show, everyone.
Yeah.
Hey, I used to host this show.
We'll see you. You did. So, for
10 minutes.
Yeah, we'll see you in 2 years or something. So, yeah. Thanks, Rach.
See you next week.
All right. Until next time. Bye.
Any information given in this podcast is for entertainment purposes only, and you should seek your own property advice before acting on anything you may hear in this podcast. If you want to start or advance your property education journey, John Pidgeon's book, Sort Your Property Out and Build Your Future, is available where all good books are sold, or via the link in the podcast show notes. Opinions or comments from any guests on the podcast are theirs and not those of the hosts, the publisher, or their respective license holders.